The first and most essential step in reading trend direction within market structure is identifying where price is currently headed. In simple terms, you need to determine whether the market is trending or moving sideways. Price usually behaves in only two broad ways, either advancing in a clear upward or downward trend, or pausing in a consolidation zone where it moves sideways and gathers liquidity. These pauses are a normal part of price delivery. Think of the market as rotating through cycles of rising trends, falling trends, and range-bound periods that absorb institutional orders and liquidity. So when you open your chart, the very first question to ask is this: is the market climbing, dropping, or moving sideways? Now let's break down exactly how to recognize that. In an uptrend, price creates a sequence of higher highs and higher lows. This shows that buyers are in control, gradually driving the market upward. Price usually takes out previous highs while defending the lows. That is why in an uptrend, your primary objective is to look for buying opportunities. The uptrend stays valid as long as the most recent swing low remains intact. But once sellers gain strength and price breaks below that level, the trend is considered broken. For instance, if price falls through this important low right here, the uptrend may be coming to an end. Now, the same logic applies in reverse when the market is in a downtrend. In a declining market, price forms a sequence of lower lows and lower highs. This time, sellers dominate the movement, driving price downward by breaking previous lows while keeping the highs protected. During a downtrend, your attention should be on selling opportunities. The downtrend only ends when buyers step back in with strength and price finally pushes above the most recent swing high. Now, you might be asking why identifying trend direction plays such a critical role in trading. There is a reason traders repeat the phrase that the trend is your friend. One of the core principles in trading is avoiding positions that go against the prevailing market direction. And that is why recognizing the broader trend is so important. It keeps you aligned with the flow of the market and helps prevent unnecessary losses. Hello and welcome back to the Com Lucro channel. Now that you understand how price moves between trends and consolidation, the real challenge is dealing with imperfect market conditions. Price rarely moves in clean structures. It often breaks levels, triggers stops, and creates false signals that trap unprepared traders. In this video, we will connect those pieces. You will learn how to separate major swings from minor swings, avoid fake reversals, and correctly validate break of structure and change of character, so you can stay aligned with direction and read price with clarity. Let us get started. Here is an example of how an imperfect trending market can appear. At first glance, price may look messy and directionless, but in this video, we will show you a method that turns this unclear chart into a readable and structured trend. The key idea is that in imperfect trends, your focus must stay on the overall structure instead of reacting to every small break. Many of these short-term reversals are temporary and often exist only to trigger stop losses or collect liquidity from retail traders. The first concept we will cover is how to separate major swings from minor swings. When does a swing high or swing low carry real importance, and when is it considered weak? In an uptrend, major swing lows are the critical zones where breaks of structure originate. This level represents the highest price recently reached after taking a previous high, meaning the starting point of that impulsive move defines our major low. A change of character happens when price breaks below this specific level. The remaining swing lows are classified as minor, and a break below them does not signal a genuine reversal. Now, here is a key point to understand. A level can only be classified as a major swing after a valid break of structure has occurred. For example, this low cannot be defined as a major swing low until price delivers a confirmed break of structure. This level represents the highest price recently traded, and a break of structure is only valid when price clearly moves through it. As explained earlier, only after a valid break of structure can a level be labeled as a major swing. For that reason, this level becomes the major swing low, while the remaining ones are considered minor. A break below a minor swing low still signals a loss of bullish strength. If there's a strong justification, such as a reversal liquidity sweep coming from a higher time frame key level, you may consider a short trade targeting the major swing low. This is because once price reaches this area, supply and demand come into conflict, and we often anticipate a reaction when price taps into this major low. Still, trading against the primary trend carries higher risk, as it increases the probability of being stopped out, essentially moving against the flow of the market. Now let us review the bearish case. The ability to separate major swings from minor ones allows you to correctly define market direction and identify real reversals. After price breaks the lowest recently traded level, the starting point of that impulsive move becomes our major high. On the Euro-Dollar 1-hour chart, we can observe 1, 2, and 3 moves breaking below this low, establishing a trend. The origin of this move is defined as the major high. As long as price stays below this level, the market remains in a downtrend. Let us continue the process of identifying major and minor swings. When price breaks through and forms a new low, we label the level where that break of structure started as the new major swing. If price only wicks with one candle below the recent low, this is not a valid break of structure and is therefore classified as a minor swing. A move above a minor swing does not signal a change in character. A real reversal only occurs when price breaks above the major high. We keep marking major and minor swing highs until a valid change of character appears, confirming a potential reversal and shifting our directional bias to bearish. In this example, we have a change of character defined by 2 clear wicks breaking above the last major swing high. However, it is important to emphasize that a change of character is only considered valid when either 2 or more wicks clearly exceed that level, or when a candle decisively closes beyond it. Then a break of structure must occur after this condition is met, confirming that the previous bearish structure has been invalidated. Another factor that strengthens the validity of a change of character is when the move is strong enough to break through the last 2 swings, not just one. If this does not happen, as in this case, the change of character is classified as a fake change of character. Now we move into one of the most crucial aspects of market structure, the break of structure, commonly referred to as BOS. You've probably come across the term BOS in trading tutorials, market structure videos, or technical handbooks. In most of these, a bullish BOS is described simply as a case where price breaks a previous high to the upside. While that basic definition is not incorrect, it's incomplete. In practice, there are specific rules and validation criteria that must be met before we can confirm a true and valid break of structure. So, let's now look closely at those key points and rules. A valid break of structure occurs when price breaks and closes above the most recent higher high, and, importantly, this break must be confirmed by the body of a candle, not just a wick. This rule applies even if price immediately retraces downward after the breakout. When such a valid BOS happens, the market creates a new major high and major low, effectively establishing a new trading range. If after this new range is established, price then breaks the newly formed major low to the downside, it suggests a potential trend reversal. This shift signals that the market is no longer maintaining its bullish structure, and we identify this as a change of character, a clear warning that the direction of the trend may be turning. However, not every apparent breakout qualifies as a BOS. For example, if price only pierces the previous high with a long wick or shadow, but the candle body closes back below that high, and the next candle's wick does not exceed the previous one, then this move does not represent a valid break of structure. In such a case, the move is treated as an internal fluctuation within the existing range, not a genuine breakout. Therefore, to properly identify a true reversal or a legitimate change of character, We must patiently wait for price to break the major low located at the extreme, rather than reacting to the break of a smaller internal high. This disciplined distinction between valid and invalid BOS signals is what separates structured analysis from emotional trading decisions. Now, let's consider another important scenario. Suppose the price breaks the most recent higher high with a wick, and the body of that first candle closes below the high's range. Then, the next candle's wick exceeds the previous wick. In this situation, we can classify it as a valid bullish break of structure. When this happens, a new major high and major low are formed, defining our updated trading range. Within this range, the internal price action, the smaller fluctuations or short-term pullbacks, doesn't hold structural significance. As long as the price remains above the newly established major low, we continue to consider the market bullish, with the trend still intact. Only when price breaks this newly formed low to the downside can we confirm a valid trend reversal or a change of character pattern, signaling that the bullish momentum may be ending. Now let's briefly shift focus to the bearish scenario, which mirrors the same logic, but in reverse. In a bearish market structure, for a break of structure to be valid, the price must break and close below the most recent lower low. And this confirmation must come from the body of a candle, not just a wick. However, if price breaks that low and then moves upward to break the newly created major high, this indicates a trend reversal, a sign that sellers have lost control and that buyers are regaining strength. On the other hand, if price breaks the recent lower low only with a long wick or shadow, but the body of the candle closes above the range of that low, and the next candle's wick does not exceed the previous wick, this move cannot be considered a valid bearish BOS. To confirm a true bearish break of structure, we must wait for a candle to close below the range of the low with its body, ensuring that the breakout reflects real selling pressure and not just temporary volatility. This clear distinction between wick-based false breaks and body-confirmed structural breaks helps traders avoid premature entries and stay aligned with the true market direction. On the other hand, if the next candle's wick surpasses the first candle's wick and its body closes above the range of the low, then we can confidently classify it as a valid break of structure. After this confirmation, we must update our major low and major high to reflect the new market dynamics. As long as price remains below the newly established major high, the market should still be viewed as bearish. Only when price breaks this newly formed major high to the upside can we treat it as a valid trend reversal or a major change of character. Having explored several types and scenarios of BOS patterns, and now possessing a clear understanding of what defines a valid break, we can move forward to another critical concept in market structure mapping, the change of character. To correctly identify a valid change of character, the first step is to determine the overall market direction, whether the market is currently in an uptrend or a downtrend. Once that's established, the next step is to mark all valid BOS points on your price chart. Let's take the bullish scenario as an example. Imagine price forming a series of valid breaks of structure to the upside. The low and high linked to the first valid bullish BOS define our major structural boundaries. As mentioned earlier, any movement that develops within these two structures is considered internal price action. Now, change of character patterns can be divided into two categories, minor and major. Each time price breaks an internal low, it produces a minor change of character. However, it's essential to understand that a minor change of character alone does not indicate a full structural shift or a reversal in market direction. It merely shows temporary weakness within the broader trend. This brings us to a very common mistake that many novice traders make. Traders who fail to correctly identify the true market structure often misinterpret a minor change of character as a complete trend reversal. They see a single internal low being broken and assume that the bullish phase has ended, prompting them to enter short positions prematurely. Typically, they place their stop loss just above the internal high, which makes them vulnerable to being stopped out as the market resumes its upward movement. However, contrary to their expectations, the price, after a brief retracement, reversed upward and continued its bullish movement. This upward push resulted in triggering the stop losses of traders who had entered premature short positions. Many of these traders failed to understand why their stops were hit, and unfortunately, they tend to repeat the same mistake again and again. What they overlooked is a critical detail. Price never broke the major low that was needed to confirm a true market structure shift. They shouldn't have entered short positions until the market broke the last major low to the downside. Their so-called change of character was actually invalid, since price was merely completing a retracement phase before resuming its primary bullish direction. To identify a valid market structure shift, a trader must wait patiently for price to create a major change of character by breaking and closing below the last major low, the one that initiated the previous bullish impulse leading to the break of structure. Furthermore, it's essential to always remember this rule. In a bullish scenario, a change of character is considered valid only when price breaks and closes below the last major low with the body of a candle. If price merely pierces the structure with a long wick or shadow, and the body of the candle closes back within the previous range, then this change of character is invalid and cannot be interpreted as a structural reversal. The same concept applies to the bearish scenario. For a valid change of character, price must break and close above the recent major high with the body of a candle. A simple wick or shadow is not enough to confirm a true shift in trend. Before we wrap up, it is important to connect everything we discussed so far. Throughout this video, we focused on reading market structure correctly, identifying real direction, and avoiding false signals caused by minor breaks and liquidity-driven moves. Structure and change of character provide context, but execution still depends on choosing the right areas to interact with price. Marking a level on the chart is not enough. The real challenge is knowing which zones are likely to be respected and which ones will be ignored. That is why fair value gaps and order blocks must be viewed through the lens of structure, direction, and liquidity. To make this clearer, I'm going to show a short clip that demonstrates how price reacts to these zones across multiple time frames, and how execution only works when it aligns with context. Let us take a look. This clip reinforces a simple core idea. In this video, you will learn how price behaves around order blocks and fair value gaps on different time frames, how to identify which zone carries the highest probability in each scenario, and how inefficiency and liquidity voids influence entry precision. You will also see how changes in character and structural shifts guide the selection of the best entry method. These insights form a practical decision-making blueprint that helps you avoid unnecessary refinement, improve your hit rate, and stay aligned with the true behavior of price as it moves between liquidity pools and mitigation zones. So let us begin. As you already know, order blocks and fair value gaps are two zones that smart money traders rely on when setting their entries in the market. Still, many traders struggle to understand which of these areas carries the stronger probability and is more likely to be respected by price. In this example, the market reacts to the higher time frame order block, but ignores the lower time frame one. This reveals an important insight. When price repeatedly fails to reach your entry, it often means the setup has been refined more than necessary. Entries only work when they align with market structure, direction, and liquidity. When these elements are clear, it becomes easier to judge whether price will react, continue deeper, or ignore a zone. Traders who align structure, liquidity, and execution consistently choose higher probability entries and avoid losses caused by poor context or over-refinement. Please also remember that our mission here on the Lucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the Lucro Trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.